I'm Georgia Williams with the Investing News Network, and joining me today is Brien Lundin, editor of the Gold Newsletter and CEO of the New Orleans Investment Conference. Good morning, Brien.
Good morning, nice to be with you.
It's nice to see you today. At your presentation yesterday, you said that if you like gold, you should love silver.
Right.
But the silver-gold ratio has been as high as 96.5 in the last 24 hours.
Yeah.
Why is there such a discrepancy and lag?
Well, what happens is when gold moves violently in either direction, it's typically over a short period of time, and silver doesn't mirror that move on the upside.
Right.
It's typically a geopolitical event that's driving it, safe haven fear, fear investing. When gold goes down considerably, it's typically a liquidity type event like we saw on Friday. So silver just didn't really follow along, and silver actually got hit more on the downside because it also has this perceived industrial demand. And so people sold it because they thought there was an economic slowdown coming on, so they sold silver more energetically, more enthusiastically. In reality, silver's value is it's much more valued as a monetary metal, and its industrial demand has very little effect on its real value. But in times like that, when there's no rhyme or reason in the markets, when there's a liquidity crunch, you really can't find any rhyme or reason. So silver suffered more, and therefore the silver-gold ratio went to its historic highs and soared to its historic highs in that day. I still think silver in a longer-term monetary bull market, like we're in now, and like I think it's going to be going on for the next few years, silver will outperform gold. It always has in these kinds of markets in the past. And it's really in what they call an unexpiring option on the gold price. And we'll give you leverage to gold by holding just a different physical metal.
Right. And I was reading a report last week talking about silver demand weakening a little bit in China in regard to use in solar panels.
Yeah.
So that's another use that maybe people don't think about when they're thinking silver.
They do, and frankly, I say it doesn't have much industrial demand. That is an important component of silver demand, but still silver is primarily a byproduct of metal. So there are very few pure silver mines, at least in relation to global supply flows. So demand flows for silver from industrial usages, especially in industrial usages where the cost of silver doesn't have much of an impact on the final price, doesn't really affect the price of the metal. It's the demand on the margin, investment demand is a monetary metal that tends to drive the price.
Right. And now with sort of what's going on in the world now with coronavirus and some of the economic uncertainty, there's been talk that central banks will lower interest rates, and this could happen as soon as March when the Federal Reserve meets. Do you see that happening, and if so, how will it impact the market?
Yeah, it will happen. I think people need to look at it from two standpoints. What will be the economic effect, and what will be the effect on the markets? The economic effect will be zero, nothing. The rates are already too low. There's no impediment to borrowing money and money flows right now. So lowering interest rates will have no real effect on the markets, but it will have the psychological effect on the markets. And that's important. That's what the markets are looking for. If it wasn't for the coronavirus, they would have come up with some excuse down the road sometime this year to demand rate cuts from the Federal Reserve, because the Fed has created this financial market monster, and it has to feed the beast now. And every now and then, the markets say they need not just easy money, they need ever easier money. Right. So they'll come up with some excuse. In this case, it happens to be a legitimate excuse, and they latched onto it pretty well.
Right. But this will be the fourth rate cut in less than a year. And like, how low can it go before there's nowhere to go? That's
an interesting question. I have a chart in my presentations that shows since the 1970s, every rate cut cycle by the Federal Reserve, and in every economic downturn or recession, in some cases just an insurance against a slowdown in the economy, the Fed has gone through a rate cut cycle. And the bottoms of those rate cut cycles is always lower than the previous, and the subsequent tops are always lower than the previous tops. So I put red lines in the chart at each bottom, and it's just a stair step down until obviously after 2008 we reached zero. And projecting the next stair step down is in the basement. negative rates. And people say that won't happen in the US. We even have Federal Reserve governors and presidents saying that that won't work in the United States. It's not a valid policy, we won't pursue that in the United States. But if you think about it, in fact, if you talk about that now, people think it's crazy talk. If you think about everything that's happened over the last decade or 12 years, before that, zero interest rate policies, negative interest rate policies, quantitative easing, TARP, all of this stuff was crazy talk, and now it's been normalized.
Right. And speaking of sort of economic uncertainty, we have the coronavirus sort of dominating the news cycle. How impactful do you think it will be on gold in the long term and the other precious metals?
I think it will be impactful in gold in that it's bringing forward this central bank easing, this wave of stimulus that I frankly didn't expect until later this year for some reason. So that's been brought forward because now there is a valid reason for it. The actual effects that it will have, I'm not a medical expert, but just looking at it, I don't think it'll have a significant effect, but perception is reality. There is a hysteria involved with this. I think there are one or two more shocks to the market of news coming out. A significant rate of infection in the US or Canada, once there's news that there are hundreds of cases in North America. I think that's a bit of that's going to be another bludgeon to the market when that news comes in, and I think it is coming. But again, it's hysteria, it's perception becomes reality. I don't think it's going to be a bottom line effect, but I think the psychological effect will be quite significant.
So what can investors do to prepare themselves? Like, while shares are low, should they be diversifying? Should they be looking towards all gold? What should they be doing?
If you look at these kinds of events as creating blips in the market that's rising, and I think you should take advantage of these, look at them as buying opportunities. Now everybody has their own individual situation, and I can't advise people individually on their specific needs, but I think you look at these long-term cycles, if you look at an underlying thesis that argues for, say, with gold and silver, much higher gold and silver prices. And my view on that is that debts, particularly sovereign debts in the Western world, are so great now that we can never really have normalized interest rates. In fact, we have to have negative real rates, rates adjusted for inflation going forward. Otherwise, the cost of servicing those debts would crush government budgets. So with that as a backdrop, there's a long-term view for much higher gold and silver prices. That's enormously bullish for gold and silver. If you have that view, if you see a sustained uptrend in place, then you want to buy at bottoms like this and look at opportunities at levels like this, because it has happened before.
Right. Well, thank you very much for joining me today, Brien.
Great to be with you. Thank you so much.
It was lovely to see you. I'm Georgia Williams with the Investing News Network.